I want to begin with a question that I believe is troubling nearly every gold and silver investor right now. You bought gold. You watched the geopolitical chaos unfold. You followed the traditional playbook. You did what seemed right. And yet your gold stack, your gold ETF, your silver position, all of it is in the red. Gold is down 13%, down 14%. Silver is down more than 46% from its January high. And at the same time, bombs are still falling across the Middle East. Central banks are still buying gold at roughly double the historical average. And the national debt has now surged past $39 trillion. So let me ask you directly, do you actually understand why this is happening? I do not mean the surface level explanation. I mean the real mechanism underneath it. Because if you do not understand that mechanism, you are going to make the wrong decision at exactly the wrong time. And that decision could cost you the most important trade of the next 5 years. I have spent more than 40 years studying how gold and silver behave during geopolitical crises. And what I'm about to show you is not an opinion. It is a mechanical sequence, a pattern that has repeated after every major oil shock since 1973 without exception. Every single time. And once you see it clearly, you cannot unsee it. And once you understand what always comes next, the part almost nobody is talking about right now, you will understand why I am using the word unthinkable. By the end of this, you will understand the exact mechanism that pushes gold lower during war. You will understand the historical record of what gold and silver have done after that drop over the last 50 years. You will understand the four-phase recovery pattern that I have watched repeat after every major oil shock of my career. And you will understand why the structural setup in 2026 is more extreme than anything I have seen in any previous cycle, which means what comes next could be larger than anything we have seen before. Subscribe now. Let me start with the mechanism, because until you understand this, nothing else will make sense. Here is the question that most financial media refuses to answer clearly. Why does gold fall during war? At first glance, it seems completely backward. Gold is supposed to be the safe haven, the financial shelter, the asset you buy when the world catches fire. So why, when Iran closed the Strait of Hormuz on March 4th and bombs began falling across the Middle East, did gold drop from $5,419 to $4,612? The answer is a mechanical sequence. Write this down, because once you understand it, you will recognize it every time it appears, and you will never be caught off guard by it again. Step 1. A geopolitical event creates an oil shock. The Iran war pushed Brent crude from $75 to above $112 per barrel in just 3 weeks. That is one of the largest energy supply disruptions in the last 50 years. Step 2, the oil spike drives inflation expectations higher. Not actual inflation immediately, but expectations. And in financial markets, expectations matter almost as much as reality. When traders believe inflation is coming, they price it in immediately. Step 3, rising inflation expectations prevent the Federal Reserve from cutting rates. The Fed had been signaling that rate cuts were possible. The oil shock ended that conversation. Fed funds futures now show almost no probability of a cut before late 2026 at the earliest. Step 4, if the Fed cannot cut rates, bond yields remain elevated or move higher. The 10-year Treasury yield is currently 4.39%. That means a risk-free U.S. government bond backed by the full faith and credit of the United States is paying 4.39% annually. No credit risk, no storage costs, no metal sitting in a vault, no income drought, just yield. Step 5, when bond yields are that high, the opportunity cost of holding gold, which pays nothing, rises sharply. Institutional capital does the math, and some of that capital rotates out of gold and into treasuries. Step 6, at the same time, global investors seeking safety buy U.S. treasuries. That demand for dollar-denominated assets strengthens the dollar. The dollar index rose above 100. And a stronger dollar mechanically suppresses the dollar price of gold because gold is priced in dollars. When the dollar becomes more valuable, it takes fewer of them to buy an ounce of gold. So now you have three headwinds hitting gold at once. All three caused by the same oil shock that, by conventional thinking, should have been bullish for gold. That is why your gold is red while the world burns. And that is why gold has always gone red for a period during every major geopolitical oil shock of the last 50 years. But this is where the story changes completely, because this mechanical suppression does not last forever. I have watched it resolve the same way every single time. And I want to show you the historical record, not as a promise because past performance guarantees nothing, but because the pattern is so consistent and so structurally grounded that ignoring it could become the most expensive mistake you make. OPEC cuts production and places an embargo on the United States. Oil rises from $3 to $12, a fourfold move. Gold initially falls, then goes on to rise 150% over the following 2 years. If you zoom out and look at the entire 1971 to 1980 period, the full arc of the inflationary oil disaster that began when Nixon ended the gold standard, gold rose 2,300%. Not a typo, 2,300%. Then came the Iranian Revolution. The Shah fell. Oil production collapsed. Oil prices rose to levels that seemed unimaginable at the time. Gold did almost nothing at first. Then over the following 12 months, it rose 89%. Then another 10% the year after that. Then the Gulf War. Iraq invaded Kuwait. Oil spiked. Gold jumped roughly 10% in a matter of weeks. Energy stocks and defense stocks outperformed nearly everything. Then came the post-9/11 world. Markets crashed. Fear spread everywhere. And then gold began a decade-long bull run, rising from $250 an ounce all the way to $1,900. That was a 660% move over 10 years. Then Russia invaded Ukraine. Gold broke above $2,000 for the first time. New all-time highs. Every major oil shock of the last 50 years has been followed by major gold outperformance. Not because of luck, not because of coincidence, but because the mechanism that temporarily suppresses gold during the shock, higher yields, a stronger dollar, and forced institutional selling eventually reverses. And when it reverses, the structural case for gold reasserts itself with full force. Now, here's what you need to understand about 2026 specifically. What makes this moment different from every previous cycle is not the war itself. It is the structural conditions the war landed on top of. In 1973, U.S. national debt was around $500 billion. Today, it is $39 trillion. That is not just a bigger version of the same thing. That is a fundamentally different fiscal reality. In 1973, central banks were selling gold. Today, central banks are expected to buy around 755 tons of gold in 2026. That is still well above the pre-2022 average of roughly 400 to 500 tons annually. 3 consecutive years of purchases above 1,000 tons were followed by continued elevated buying. That is not simple diversification. That is strategic repositioning at a scale the gold market has never seen before. In 1973, there was no silver supply deficit. Today, silver is in the middle of a structural deficit, with industrial consumption continuing to exceed mine supply for a 5th consecutive year. 5 years of demand greater than supply. 5 years of inventory drawdown. 5 years of an imbalance that does not resolve easily because most silver mine supply is produced as a byproduct of other metals. You cannot simply decide to produce more silver because the price is rising. In 1973, industrial demand for silver was only a fraction of what it is today. Today, silver goes into solar panels, electric vehicles, AI data centers, defense systems, and semiconductors. The industrial base supporting silver demand today is larger, more inelastic, and less replaceable than anything that existed in earlier cycles. And in 1973, the Federal Reserve still had room to raise rates to 20% under Paul Volcker in order to break the inflation caused by the oil shock. That response, brutal as it was, eventually broke the inflation cycle. Today, the Federal Reserve is paying roughly $1.03 trillion a year in interest on $39 trillion of debt. It cannot raise rates to 20%. The arithmetic simply does not allow it, which means the oil shock from the Iran war is embedding itself into an inflationary environment that cannot be addressed through the same mechanism that resolved the 1970s version. Every structural condition is more extreme. Every structural driver is more powerful. And the mechanical suppression currently holding gold at $4,612, while JP Morgan's year-end target is $6,300, Wells Fargo's target is $6,100 to $6,300, and UBS's target is $6,200 by September, is temporary. That gap between where gold is now and where the most sophisticated institutional forecasters believe it is going, that is the unthinkable move I am talking about. Now, let me walk you through the four-phase recovery pattern, because understanding which phase we are in changes everything about what you should do with this information. Phase 1, the panic phase. This usually lasts from the first week to the first month after a geopolitical shock. Oil spikes. Gold spikes initially, then drops hard as the mechanical sequence I described begins to take hold. Financial media runs nonstop coverage with dramatic music and red graphics designed to maximize fear. Most retail investors do one of two things. They panic sell at the bottom of the initial drop, or they panic buy gold at the top of the initial spike. So, despectating des. Both are usually wrong. What are institutions doing in phase 1? Watching patiently. They have seen this movie before. They do not do anything dramatic. They position carefully while retail investors either run for the exits or chase the move. Phase 2, the absorption phase, usually months 2 and 3. The initial panic fades. The VIX comes down somewhat. Gold pulls back from its spike, sometimes significantly. Silver falls more, often 15 to 20% or more. This is where the largest number of individual investors make their most expensive mistake. They look at their portfolio, see red, read a headline saying gold is broken or has failed as a safe haven, and they sell. In my 40 years of watching markets, I have seen this after every major crisis. And in almost every case, it was the worst possible time to sell. Not because I am always right about what comes next, but because phase 2 is very often the bottom. And selling at the bottom is how people lock in losses instead of participating in recoveries. Phase 3, the structural bid phase, usually month 4 through month 18. The broader market begins to stabilize. The panic-driven institutional selling that depressed gold in phases 1 and 2 exhausts itself. Then the structural buyers begin stepping in. Central banks buying regardless of short-term price. Institutions rebalancing into real assets. Retail investors finally comfortable enough to return. Gold begins to find a bid again, not the panic bid from phase 1. A structural bid backed by central bank buying, silver supply deficits, and debt dynamics that make monetary debasement increasingly inevitable. Miners begin to leverage improving gold prices. Energy infrastructure stocks rally as supply disruptions are priced into the medium-term outlook. And most retail investors are still sitting on the sidelines, having sold in phase 2, too afraid to get back in. They watch gold move higher and tell themselves they will wait for the pullback. The pullback may never come. Phase 4, new all-time highs, usually beginning sometime after month 12 and sometimes lasting 2 to 3 years. This is what history shows after every major oil shock. 1979 to 1980, new all-time highs. Post 9/11, new highs sustained for a decade. Post 2022, new highs again. The mechanism is always the same. The oil shock embeds inflation. Inflation forces the Fed to keep rates elevated longer than the economy can comfortably sustain. Eventually, debt arithmetic overwhelms the inflation-fighting mandate. The cost of servicing $39 trillion at 4 to 5% becomes too large. Rates come down, the dollar weakens. The three headwinds I described reverse at the same time, and gold responds to all three tailwinds at once. Now, let me be honest about where I believe we are right now. Based on the timeline of the Iran war and the price action I'm watching, I believe we are somewhere in the transition between phase 2 and phase 3. The panic selling has happened. The forced liquidation from margin calls has largely run its course. The structural buyers, central banks, long-term allocators, and physical buyers in Asia are beginning to accumulate at current levels. Ed Yardeni, while lowering his 2026 year-end forecast from $6,000 to $5,000, is still holding to $10,000 by the end of the decade. That is not a bubble forecast. That is a debt cycle forecast. Now I want to address what may be the most important insight I can give you about silver specifically, because silver's story in this cycle is not the same as gold's. And most investors do not fully understand that difference. Gold led the first phase of the trend because it responds first to sovereign and monetary stress. Silver initially lagged, then began reacting later, but with much greater velocity. That dynamic, silver trailing gold's breakout and then moving harder, creates a natural expansion and contraction in the gold-silver ratio. In the 1979 cycle, silver did not simply follow gold. It outperformed gold by a factor of 3. Gold rose about 276% from the Iranian Revolution to its 1980 peak. Silver rose from roughly $5 to $50, a tenfold move. Why? Because silver is both a monetary metal and an industrial metal. In a crisis, the monetary characteristics drive the first move. But as the crisis embeds itself deeper into the economic system, the industrial side adds a second engine that gold does not have. And in 2026, that second engine may be more powerful than in any previous cycle. Solar panels require silver as a conductor, and that demand is not highly price sensitive because silver remains a small share of the total system cost. Electric vehicles require roughly 60 to 80 grams of silver each, compared to around 15 to 20 grams in a conventional vehicle. AI data center cooling systems, defense electronics, and satellite communications all rely on silver. And in many of those applications, there is no easy substitute without sacrificing performance. Then there is the supply constraint. The market is now in its 5th straight year of industrial demand exceeding mine supply. Supply elasticity remains low because most silver comes as a byproduct of mining copper, lead, or zinc, meaning output is driven more by the economics of those metals than by silver itself. 5 consecutive years of deficit. No meaningful supply response. A rising industrial demand base in sectors where silver often has no viable substitute. And China, which controls around 60% of global silver refining capacity, has restricted silver exports as a strategic material. So, when the monetary bid returns to silver, which history suggests it will in phase 3, the industrial demand that has been present all along adds fuel to the move instead of subtracting from it. That is why silver often lags gold on the way up, then overtakes it dramatically. Now let me close with the 2 indicators I am personally watching to identify when the move from phase 2 into phase 3 has truly arrived. The first is the U.S. dollar index. It is currently elevated above 99 because of the surge in petrodollar demand created by the oil shock. When the DXY falls back below roughly 97, the primary mechanical headwind suppressing gold begins to weaken. That will likely happen when oil stabilizes and when alternative supply routes through Saudi pipelines and Emirati bypass infrastructure absorb enough of the Hormuz disruption to reduce the emergency dollar demand created by the shock. The second indicator is the 10-year Treasury yield. It is currently 4.39%. When that falls back below 3.1%, so I was 5%. The opportunity cost argument against gold weakens to the point where institutional rotation out of treasuries and back into gold becomes mechanically favorable. That will happen when the Federal Reserve begins cutting rates, which it will eventually be forced to do once the arithmetic of $39 trillion in debt at 4 to 5% becomes too dangerous to sustain without triggering a fiscal crisis worse than the inflation it was trying to contain. Those are the two indicators that will tell you when the mechanical suppression is ending. The war headlines will not. The daily oil headlines will not. The financial media's 24-hour noise cycle will not. Watch the dollar, watch the yield. Everything else is noise. Wells Fargo Investment Institute has lifted its year-end 2026 gold target to $6,100 to $6,300 an ounce, up from $4,500 to $4,700. JP Morgan forecasts $6,300 by year-end. UBS has increased its target to $6,200 by September 2026. These are not retail investor fantasies. These are the research departments of the institutions managing more capital than almost anyone else on earth. They are not issuing these targets because they believe the current mechanical suppression is permanent. They are issuing them because they believe it is temporary and because they have done the structural analysis of central bank buying, supply deficits, debt dynamics, and rate trajectory that suggests the suppression will eventually exhaust itself. There are two types of investors watching this unfold right now. The first sees gold at $4,612, down from $5,595, and concludes the trade is over. They sell at the bottom of phase 2. And 6 months from now, when gold is making new all-time highs, they will say, "I knew I should have held." The second sees the same price and thinks phase 2 absorption, mechanical suppression, structural setup now more bullish than it was at the top, and they accumulate quietly, patiently while the noise is at its loudest. I have watched both types of investors through every major crisis of the last 40 years. I know which type builds wealth, and I know which type watches it happen from the sidelines. The unthinkable move in gold and silver is what comes when phase 3 fully begins. Not unthinkable because it has never happened before. It has happened after every major oil shock of the last 50 years. Unthinkable because the structural conditions behind it are more extreme than anything I have seen in 4 decades of watching these markets. More debt, more central bank buying, more silver deficit, more industrial demand, more fiscal constraint on the Federal Reserve. Watch the dollar, watch the yield, be patient, and do not let a phase 2 sell-off cause you to miss the move that the world's biggest institutions have already begun calculating.